Did the economy burst the AI bubble too? I said about a month ago that there wasn't just one red flag, there was an entire marching band of red flags streaming across the data as well as the global system. And those were warning that something big had changed. And then that change shows up in the stock markets. So it's not about stocks or AI, it's much bigger. And when we look back and reassess what that was, we get a sense of where things are going. Because most people, they still want to know if what just happened this past weekend was some anomaly, a one-off for just anyone exposed to Japan or the AI bubble to worry about. But since it very much appears as though it was the real economy which did the trick, we can't simply chalk it up to the usual euphoria wearing off, nor is this some small matter of rethinking prior rationalizations on solely equities. What's unfolding right now is a repricing of everything, up to and including the AI bubble or stocks as a whole, and everything else in between and beyond. I said a few days ago, the financial world has changed, and it started to really shift about a month ago. And ironically, it was the very thing Fed officials have been focused on, if for all the wrong reasons, which seems to have pushed the stock markets over the edge. And if that's what really has happened, we got a lot more than equity indexes to worry about here. This isn't about AI, NASDAQ, or the Nikkei. We might be really heading into some rare territory. So let's start with the Nikkei, the stock market indexes, to start piecing together what may have happened so that we can understand where we might be going here, both in the near term as well as, more importantly, the long run. And Japan's major stock index, the Nikkei 225, hit its all-time high, particularly specifically on July 11th. July 11th is a date that we keep coming back to over and over again, which I'll get to in just a moment. Its all-time high of 42,224.02 was on, as I said, July 11th, and it was down more than 25% through Monday, and then it came back a big rebound on Tuesday, and it's up again a little bit today, but it's still down about 17% from that July 11th high. So from euphoria, high, AI, everything's great, to suddenly a 25% decline in a matter of what seemed to be a blink of an eye. In fact, 20% of that decline came in just 3 days, Thursday, Friday, and Monday. So it seemed like this was the AI bubble reversing, or this is something about Japan, and there was a lot about Japan in it, but it was broader than just the stock market. But it all goes back to July 11th. In fact, that was the same time as the NASDAQ, the US NASDAQ stock index. It hit its high on July 10th, so basically the same day. 18,647.45 was the high for the NASDAQ, and through Monday, the big sell-off, it was down 13%. Now, it's come back a couple percentage points since then, but still, it's down over 11% since July 10th. And as the stocks were going down initially from their all-time highs, the mainstream media was filled with stories about the Great Rotation, or what many people were calling the Great Rotation, that this was finally the point at which the stock bubble, they didn't call it the stock bubble, but the stock bubble was going to broaden out. It wouldn't be so narrowly focused on the Magnificent Seven or just the AI bubble stocks, that suddenly small caps were getting a bid in equities. So the initial decline in the big cap indexes, in particular the big cap stocks, seemed like it was just a rotation within the equity markets. But it wasn't just that, because eventually the S&P 500 and the Dow Jones Industrial Average in the US, those hit their highs a couple days after July 11th, and then they started to move lower too. And many people started to realize that it wasn't some great rotation within the stock market, there was something else going on. So a lot of attention focused to specifically AI. Was this just the AI bubble being burst? And Japan and this Nikkei caught up in it as the epicenter of all of that. But then we look around beyond just equity indexes or just share prices in general, we see a lot of other correlations and correspondences too. For example, silver. Silver hit its all-time high way back in the end of May, but it had been down and seemed to be bouncing in early July until July 11th. On July 11th, it hit its most recent high of $31.43 an ounce. And since July 11th, and really a couple days after July 11th, it's again seems like it's taken the elevator down. 14% since July 11th, and now it's under $27 per ounce. and it looks like it's continuing to be weak. And what's unusual about silver is because gold is still basically hanging in there, silver's decline is really about industrial uses, which is what the majority of silver is used for these days anyway. So silver as an industrial signal, a very sharp setback, and that one coincident to everything else that we're talking about here. And of course, we've seen copper go lower. Copper, its all-time high back in May, just like silver, and copper's trading a lot like silver. But we had another recent stabilization in the early part of July, and then from July 8th, so couple days earlier than the period we're talking about, from July 8th forward, copper seems to go down substantially from there too. And of course, with copper going down and gold basically flat to slightly lower, the copper to gold ratio has gone way down into solidly deflationary territory. So we're starting to talk more about the real economy, goods economy, industrial uses than specifically financial euphoria over equities and artificial intelligence. So copper's one that's moved lower from the early to middle part of July as well. But we also see iron. Iron, a purely industrial metal, that one has been moving sharply lower since around July 3rd. So early July, even commodities were starting to roll over. They had already been weak before then throughout June, but then the declines really accelerated from the early to middle part of July, really July 11th, 12th, and 13th. From there, right on through everything that we just experienced up to and including this past weekend. So it wasn't about stocks necessarily or AI. There was something deeper going on. And we can see it, of course, in the Treasury market. Treasury market made some similar moves too. There's some correlations, some direct correlations with everything else, including the Nikkei. The U.S. Treasury market yields started to accelerate to the downside right after July 1st. Now they had hit their highs way back, the recent highs way back at the end of April. So they were already moving lower, but really kind of modestly lower to sideways throughout June. And then once we got to July, that's when Treasury yields started to pick up. But the downturn in yields really picked up, really accelerated after July 10th. So just like the NASDAQ. And that's the thing here. The NASDAQ has been selling off even as interest rates have been moving sharply lower, which is contrary to one of the mainstream narratives that has supported the equity bubble in the first place. The idea was that Fed rate cuts or any lower interest rates would be the friend of the stock market, that lower rates were good for share prices. Here we have an example where rates accelerated to the downside in the marketplace, and so did share prices too. So what we're seeing there is that it wasn't a rotation within the stock market from large caps and mega caps to small caps or something like that. It was widespread rotation out of risk, out of risky assets and into safety, bull steepening on the curve. And again, as I just said, stocks have been getting hit. Stocks have been moving lower, generally speaking, not just in terms of the few AI bubble shares or few AI bubble names. Stocks have been moving lower at the same time interest rates have been moving sharply lower. Rotation out of risk into safety. At the same time, we see economic signals like silver and copper to gold, all of those plunging throughout July, heading into this past weekend. So that just begs the question. What really happened on July 11th that could cause all of these sharp and serious and substantial reversals? And I answered that question previously, not just in a recent YouTube video back then, but I also answered that question several times in Eurodollar University's deep dive analysis. This is something that we go over all the time in our deep dive analysis. I write about these things every day, whether it be money or macro fundamentals from the perspective of the Eurodollar system. And this is something we've gone over quite a bit. What these curves are telling us, what the curve changes are telling us, and how it all relates to macroeconomic figures as well as macroeconomic conditions that we can tell from the macroeconomic figures. And in this case, July 11th was a specific macroeconomic account. And it is, as I said in the introduction, the very one that the Federal Reserve has been so focused on all this time. July 11th, the Bureau of Labor Statistics reported the U.S. CPI for June. But it wasn't the CPI necessarily the headline. Though that was thoroughly disinflationary for the second time, it was the core CPI. That one raised all sorts of alarms. In fact, that was the red flag that I was talking about. It wasn't just one red flag, it was a bunch of them, because you don't usually see the core CPI behave in the way that it did. So here's what I said about it on July 13th, just a couple days after it was released. The June CPI report was a lot more disturbing than most people realize. It wasn't just disinflationary, it was actually too disinflationary. Now, economists and central bankers have been focused on core rates because of their perceived stickiness in inflation. However, it wasn't just that the stickiness disappeared over the last couple months, but the manner in which it did was highly unusual. To put it bluntly, you almost never see a core consumer price measure drop off like that. Its rate of change fell so sharply, this puts the current period in some very exclusive company, the kind of macroeconomic company you don't want to be in. It was easy to miss because we're talking about a huge fall off in rates of change rather than outright prices. Now, the core CPI is still rising, so it's quite understandable why most people don't immediately see the significance. But to abruptly and sharply slow like it has since March, that just doesn't happen very often. And when it has happened, nothing good is going on. Furthermore, the fact this exceptionally rare CPI shift has shown up when it did since March, with everything that's been going on with unemployment, warnings from every direction about consumers, spending, and incomes, this doesn't just raise a red flag, there's an entire marching band worth of them coming right at us. That's what was so important about the core CPI, is that it's basically made to go in a straight line. It follows a trend and it sticks with it. So whether oil prices or food prices are swinging back and forth for largely non-economic reasons in a lot of cases, the core CPI is supposed to go straight. And when it deviates, in the few instances that it has, very few instances that it has, it raises an enormous red flag and a whole marching band of red flags, as I said. Because we've only seen this type of deviation on a couple of occasions. And those occasions are not happy and good occasions. So it suggested not only some bad adverse scenarios that are on par with some of the worst cases that we've seen already, because that's what it takes to really bend the core CPI in the way that we've seen. As I talked about in that video, these are just rare moves. The last time was 2009, late 2009, as it became clear the U.S. economy was not going to recover from the Great Recession. And just before that, we saw the core CPI really make a move in late 2008 because obvious reasons with the meltdown in financial markets and the utter chaos in the real economy and the damage that it was taking from what was a monetary shortage and a monetary panic, not subprime mortgages. So late 2008 and 2009, we see the core CPI bend in a way that's reminiscent of what we've just seen over the last several months. Before then, we saw it also in 2003 at the tail end of the dot-com era. Before that, 1981 and 1982, what had been the worst recession in the post-war era up to that point. So you had the initial slowdown in the initial bend in the core CPI in 1981, and then the bigger one that's reminiscent of 2008, 2009 in 2024, during the worst part of that recession in 1982. So the core CPI wasn't the reason why markets took a hit, not necessarily the core CPI itself, but what the core CPI data confirmed about what was already happening across the entire global economy. Interest rates were already moving lower under the suspicion that recession was happening in the US, which is much bigger than just a US recession, as I keep saying. But then the core CPI comes out, and it wasn't just disinflationary, it was too disinflationary. It's too disinflationary to the point that it strongly suggested that this wasn't just a garden variety slowdown. This was more than just a downturn, and it's likely more than just a mild recession too. This was an unusual occurrence in a whole sea of unusual occurrences that have continued to move in that same direction. There's also been quite a lot of macroeconomic data on top of the CPI report, which suggested the same thing, that the cycle has indeed shifted, and shifted decisively. One of those that was kind of lost last week amidst the financial fury the manufacturing sector. That's one we talk about all the time because the manufacturing sector is a leading indicator all its own. And earlier this year, it looked like the manufacturing sector was staging a revival or a turnaround for reasons we don't need to get into here, whether it be the Red Sea, whether it be businesses were becoming more excited about rate cuts, the prospect for them. Whatever the case, there was a small potential turnaround. It wasn't really a turnaround. It was a lessening in the contraction in the manufacturing sector. As of the latest statistic for the month of July, 46.8. That was the headline, lowest since November, moving decisively lower. Backlogs continue to contract at substantial rates, down to 41.7 for the second straight month. And the shocking part of the ISM, which should have been front page news, was the employment index, which means unemployment index. The employment index for the ISM just 43.4, which was its lowest since 2020. So even manufacturing is starting to look like everything that the markets are afraid of as far as the employment picture and what that means in terms of general contraction around the US and therefore weakness that could spread through the rest of the global economy. So is this just a one-off? Is this just a stock market thing or an AI bubble thing? That's what everyone still wants to know. And because it began long before the AI bubble, because there were so many fundamental real economy aspects to it, this isn't about stocks. This isn't really about the share prices or artificial intelligence in one way or another. This is much more deeper and fundamental than all that. And the ripples of repricing liquidation that began before the indexes turned around, they're about recession. And recession is the one thing that is always bad for shares, because they ignore almost everything else except a broad contraction. And as it turns out, and we always get reminded of this whenever the cycle turns, rate cuts are not anyone's friend, and low rates don't signal anything good. So even before we got to the peak and then the downturn in the stock markets, whether Nikkei or the NASDAQ, there were already the warning signs building up behind them. Rates were going to go lower, and that was not a good thing. So long before we got to the liquidations and the share price rout of this past weekend, the change in the core CPI for June confirmed a lot of suspicions that were already being priced into the marketplace. This wasn't going to be just some minor slowdown. And as a result, that CPI report for June, it wasn't just disinflationary. As it is turning out, it really was too disinflationary. To really understand why the core CPI was such a huge deal, you really got to go back and examine the historical record, which is exactly what I did in that video I talked about, and that's the one I've got linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.